Hi, I'm Christine Benz from Morningstar.com. Morningstar's manager research analysts are constantly bringing new funds under coverage. Joining me to discuss some newly rated funds is Russ Kinnel. He's Director of Manager Research for Morningstar. Russ, thank you so much for being here.
Happy to be here.
Russ, let's discuss some newly minted fund ratings, starting with the good ones, starting with PIMCO Ginnie Mae, which upon its new rating earns a rating of silver. Let's talk about what the team likes there. And first of all, maybe let's just talk about what Ginnie Mae's are for investors who aren't steeped in the specifics of bond investing.
Right. So Ginnie Mae's are government-backed mortgage pools, and they're high-quality bonds. They come with some weird characteristics. So, for instance, there's prepayment risk. So what that means is falling interest rates means you get your money back at a time when you don't want to. So there's some quirks to Ginnie Mae's that there's some value in hiring a specialist like PIMCO or other fund companies to manage, because they're a little tricky, a little complicated.
Okay, so they are backed. Ginnie Mae's are backed by the full faith and credit of the U.S. Treasury, but have historically had a little bit of a yield premium relative to straight-on Treasury bonds. Let's talk about what you think PIMCO adds there in the Ginnie Mae space.
Right. So it's an interesting fund because it's less than $1 billion, yet we know PIMCO invests a lot in mortgages and Ginnie Mae's in particular through funds like PIMCO Total Return. So the operations behind this fund are much greater than you might initially expect. PIMCO is just a very good investor, obviously, in this space. In this particular fund, Dan Hyman takes a sort of relative value approach, which has worked quite well so far, and we think just PIMCO's a very good investor in this area.
Okay. The role of a Ginnie Mae fund in a broader portfolio, how would an investor use something like this, and could it potentially be duplicative with something else in the investor's portfolio?
That's right. So Ginnie Mae's typically make up a meaningful slug of your typical intermediate bond fund. So before you go out and buy a Ginnie Mae fund, be sure you understand what your exposures are elsewhere. If you have a fairly high-quality intermediate bond fund, you may well already have all that you need. However, let's say you own treasuries directly, or for whatever reason you don't have an intermediate fund, or maybe you want to focus more on the higher quality, more predictable part of that segment, then a Ginnie Mae fund makes sense. It's kind of a niche, but at least it's a fairly low-risk niche.
That's true. Let's talk about another one. This is a bronze-rated fund. This is American Beacon International Equity. Let's talk about its setup. It uses a multi-manager sub-advisory setup. What do you like about that general setup for mutual funds?
Yeah, so I think there's some appeal there in having multiple sub-advisors, because it takes out some of that idiosyncratic risk that you get when you just have one manager. In this case, you have 3 value managers, and of course, as you know, every value strategy has its moment where it can look pretty poor. Often it's because of recession, or maybe a sector that they like energy, is hit hard. So spreading that out over 3 sub-advisors, as they do in this fund, is not such a bad idea. In a way, it means you could, if you wanted to, make a fund like this your sole foreign holding.
Okay. So the idea with a sub-advised fund is these are not American Beacon managers. They're managers who American Beacon hires to run. And as it turns out, Morningstar really likes some of these underlying managers. You've got Causeway, Templeton,
and Lazard.
And Lazard, okay.
And so we rate Causeway Gold, we rate the other 2 bronze. And in some cases, this fund is going to be cheaper than buying those funds, the related funds directly. So I think it's pretty good value. And of course, when you have 3 portfolio managers with a more diffuse portfolio, costs are really important. So I like that element here too.
Okay. Let's talk a little bit about American Beacon. What is this firm? Investors may not be familiar with this name. And how do they buy these funds?
Yeah. American Beacon used to be part of American Airlines running their pensions. Now they're separate from American Airlines. But as you say, that's what they do. They don't run anything directly themselves. Their job is to hire multiple sub-advisors. They like value strategies and oversee them, but they tend to do with a relatively light hand. That is, they don't make rapid changes. They will make changes, but they tend to be fairly stable, low turnover with their sub-advisors. And historically, they've done a pretty good job of finding good ones, as they have in this case.
Okay. USAA Income has a neutral rating. USAA has historically been a pretty low-cost provider and a decent bond manager. What is the thinking behind this fund's neutral rating?
That's right. USAA we like in general because they're lower cost. They're pretty straightforward. In this case, though, the fund has a little more credit risk than your typical intermediate bond fund. They've got a big slug of triple Bs, and then which is the lowest rung of investment grade, and then they've got about 10% in actual high yield. And if you look at it, the returns are decent, but given the added risk, it really doesn't add up for us. So it's an okay fund, neutral, but again, we don't see anything that compelling yet.
Okay. The last fund I want to discuss is Eaton Vance Multi-Sector Income. It has a negative rating. Let's talk about what's going on there, because it does have a very experienced manager in Kathleen Gaffney, who came over to Eaton Vance from Loomis Sales. Let's talk about the issues that the team thinks are in play there.
That's right. You have an experienced manager in Kathleen Gaffney, but it's really been a disappointing fund. She came over from Loomis Sales, and as you probably know, Loomis tends to run these funds that are pretty wide-ranging, invest in a lot of areas, take on some credit risk, have a lot of foreign currency and foreign debt exposure, even have a Canadian bias, and that's here in this fund.
Some straight-up equity exposure.
And some straight-up equity exposure as well. And so on the high-risk end of bond funds, but what's different here from the Loomis Sales funds is greater concentration. So greater sector concentration, greater issue concentration, and that worries us when we see a really high elevated level, especially in bond funds where people tend to want a little lower risk. And that risk really showed up. So it's not just that they were taking risk, but they got it wrong. They had big energy bets, and the fund lost over 17% in 2015, compared with about a 2% loss for the typical peer. So essentially as a fund, if you look at its returns, it's over the about 3.5-year life of the fund, the returns are not so far off from the category average, but with massively higher volatility and risk. And you put all that together, it's just not a very appealing package. There's also been some personnel changes, so really kind of on multiple fronts we see concerns.
Yeah, okay. Hard to see how a very high-risk bond fund fits in most investors' portfolios.
Yeah.
Okay. Russ, thank you so much for being here to discuss these newly rated funds with us.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.